really tonight, like I said, I have to mention this, a disclaimer. So I'm not giving advice, I'm giving mainly education, because what we're doing today is mainly for education purposes. It's just
Yeah.
to educate people, it's not to give advice.
Okay.
I'm not giving advice, I'm not licensed to give advice on this kind of,
Okay.
forum.
Okay.
It's just
Yeah.
to give people, just to increase their knowledge. It's mainly
Mm.
just to educate people.
Hello, 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 hello again. You are welcome to another episode on this channel. And we are going to be talking about something very important to everyone, everyone. And that is, like we say, the three basic necessities of life are food, clothing, and shelter. And today we will be talking about shelter. Long while. So today's topic is about buying a new home. So we have someone who has been in the field for a really, really long while. He will be talking to you more about himself, introducing himself to you. But shortly, I will just tell you he is a financial coach and he is very passionate about helping others financially in their financial situations or issues. So he's a mentor to many. And he is going to be here talking to us about mortgages, buying. What does it take to buy a new home? What does it take how do you start if you want to buy a new home? Because we know that there's so many people who have even bought their homes, but they have very little knowledge of what they need to do next or how to come out of it if they want to come out of it or what to do to progress in it. So we have a very important guest with us today. And his profile website is themoneymentor.co.uk. Themoneymentor.co.uk. So he's a very important person, and I will be introducing him he will be introducing himself to us by himself. And before we go, I would like to say thank you for always supporting the channel, for always coming in to share the videos, like, to make comments, and we're expecting your comments. Hey, we're expecting your comments. We wouldn't be doing this without your support. So I'll be bringing on the screen Mr. Ayatunde Nurain Abudu. You are welcome again. Can you please
Thank,
introduce yourself?
thank you, Bumi. Yeah, good evening, everyone. My name is Ayotunde Nuren Abudu. Like Bumi has just introduced me. I'm a financial coach at the moment. I used to be a financial advisor. And what is it was that obviously being a financial advisor means you give advice on financial products like mortgages, insurance, and things like that. And I did that for quite a long time, for over 10 years. But then at some point, I was self-employed, did with so many people from different walks of life. But I worked out that there was a gap in financial knowledge about products. A lot of people I dealt with did not really understand much about financial products. And sometimes I had to turn people away because, for example, you want to take out a mortgage, people want to buy their first home, they come to me, oh, can I help them? Unfortunately, I couldn't help because there were certain things they had done or things they
Mm,
hadn't done in order to get to that stage. So I decided to then go take a step back. I decided not to be a financial advisor, but go more into financial education and coaching, which is helping people get to a point where they're ready to make the right financial decisions. And so that's how I set up the company called the Money Mentor. This was, I think, about 6 years ago, and we've been going since then. So
wow.
like Bumi said, I'm really passionate about helping people, and mortgage is a very passionate area for me because buying a home, most people will probably look to be financing their home, and the only way you could finance your home is through a mortgage. And is the whole process worldwide is kind of similar from one country to the other. I know we've got people from all over the world. I'm going to be talking mainly within the concept of the UK system, but the UK system is not very far off. Some of the things I'll be talking about is not very far from other parts of the world as well. There's quite a lot of similarities. It's
Okay.
just that there might be some variations, but there's a lot of similarities between anywhere else if you're looking to take a mortgage to buy a house. But we'll come to that shortly. I know
Okay.
that there are quite a lot of buzzwords which I've been, I was going to bring into my discussion, but I'll be mentioning that as we go along. And obviously, I'm sure people will have a lot of questions to ask me, which I'll be happy to answer sometime later on.
Yeah,
Thank
thank you. Thank you very much. Exactly. Questions, questions, questions. That's why we're doing this. We're doing this so you can get educated. We can all get educated about what we need to know when it comes to buying a new home. It might be a new home you're buying. It might be you're even extending your estate or whatever it is you're doing with homes. He is the right person to talk to us, to educate all of us about it. So, Mr. Abudu, what does it take to buy a home? Do you need to be a resident? Do you need to have a visa? Do you need to be, can a student buy a home? Do you need to be financially buoyant to do one? And
you.
we have so many buzzwords which we will be talking about. But first question is, what is the first step in buying a home?
Okay, thank you, Wumi. Well, the first step in buying a home really is there are quite a lot of things around your status, as you rightly asked. So I would think there are a lot of things around, as an individual, you know, for example, if it's more about starting with affordability. It's more around that. Apart from your status, fine, there's immigration status as well, because in the UK, you obviously have to have at least what we call a tier two. So if you're not a UK citizen, you need to have what we call a tier two, minimum of a tier two visa in order to buy a property in the UK. In order for you to get a mortgage. But anybody can buy a property in the UK. Anybody can come from anywhere in the world to buy a property. You pay cash. But if you're looking to take out a mortgage, then there's some certain things that need to be in place. And this is where
Mm,
things about tier two visa. Now, the other things that need to come into place, I would say, is around three things personally. I think it's around affordability. I'll just mention those three things and then I'll come back to them. So, one is affordability. One is about having a deposit, because if you're buying a house, you have to put down a deposit. If you're taking out a mortgage, you obviously have to
mm,
take out a deposit. You won't get 100% mortgage. The lender will not give you 100%. So you have to put something down, and the lender will
mm,
have to put. They will finance the rest of it. So that's how it works. So that's one thing. And the other thing is around affordability. Affordability means around what you can afford. That is the most important part. What you can afford in buying the house. So if they're going to give you a loan, they will need to know how you can afford, and then what we call affordability checks that will need to be carried out in order for the bank to check whether you're able to afford the loan or not. The
okay.
other thing, the third thing I'm going to mention is around your suitability.
Mm,
Suitability is around what we call credit, your credit scoring. You know
yeah.
how your credit status. How your credit status is. Whether you've got good credit, whether you have bad credit. I guess here in the UK, and I'm sure in most parts of the world, this thing is automated. So we all have like what a credit profile. Where as you spend money, as you manage your finances and all, there's a system which records all that. And this is the thing the lenders will look into. They will look at your financial history, how you've managed
Mm,
money in the past, you know, whether you were good at managing money, whether you were bad, and that will have an impact on whether you'll be able to access the mortgage or not. So those three things. So like I said, going back to what I've just said, the first thing is around I've mentioned the immigration status separately. But apart
yeah.
from that, like I said, you've got the three things. You've got having a deposit,
Mm,
your affordability, and then the third one is your credit status. So I'll pick on each one individually. Is that
okay.
all? I'll just go in depth into each point.
Yeah,
So
okay. Thank
so
you.
but okay, sorry. Before I go there, let me just say something in general. Now, in buying your first home or buying a house in general, you don't necessarily have. There's different ways you can buy a house. Obviously, one is you're paying cash, and the other one is you're buying with a mortgage. And there are different ways you can do that. So we're talking mainly tonight about using a mortgage, but
Yeah.
obviously you can buy cash as well. If you have the
Mm,
cash, if you can afford it, you buy the house outright. That's what we call buying with the cash. You could so anyone can come from anywhere in the world and buy a property in the UK. The only thing that will happen in that case is that when you're buying a house, you've got the process solicitors and all the people who will be, drawing up the contracts. One of the things they will need to check is the source of your funds. Where did that money come from?
mm,
things about money laundering. They want to make sure that the money is come from clean source. You know what I mean? Clean
Yeah.
source. That so that is it. But anybody can buy a house from that. Now the
Mm.
mortgage rate is what we're now. I'm going to go into fully about the mortgage rate now. Um, with mortgages, there are different ways as well. Before I go into the 3 points I mentioned earlier on, there are three ways or some ways mortgages work. So, for example, for somebody who's buying a house for the first time, there are various options to them. One option is to get a mortgage where you just put down a deposit and then the lender will give you the rest. So, for example, you could put down 10% of the value of the house you're buying. So let's say you find a property you want to buy. The property is £200,000. So you can put down 10% and the lender will give you, which is 20,000, and the lender will give you 180,000. So but then that's the mortgage. So the lender will give you a mortgage for 180. You put down 20%, which is sorry, you put down 10%, which is 20K. So the lender gives you 180K, you put down 20K. That's one option. Another option is what we call shared ownership. Shared ownership is more like a part buy, part rent. So, and the reason why you have this kind of product is because places like London or most places, house prices are really high.
Mm.
So people are unable to afford to do what I've just said. So because most of the, I'll come to that shortly. So because of that, you have the option of buying part of your property. So for example, what I said earlier on. So the example I gave you, like a property for 200,000 is to be sold. So
Mm.
ideally, you will put down 10%, which is 20K, and then the lender will give you 180K. But for you to be able to get a 180K mortgage, you have to be able to afford it. So I'm going to touch on that shortly. So, but you might not be able to afford 180K. So one option that might be, for example, is you have what we call shared ownership, where so the property is 200,000. So rather for you to get a mortgage to cover the whole amount, part of the amount, and you put down a deposit, what will happen is you could actually buy a share of the property. So part of the property will be rented, the other part will be what you will take out on the mortgage. So let me give you an example. So you might have like a 50% share in the property, which means a property which is £100,000, sorry, £200,000, you will have a 50% share of that, which is 100K, and then the 100K of the rest you will pay rent on it. So what would then happen is you have to get a mortgage for maybe like the earlier example I gave, you probably have to get a mortgage for out of the £100,000, which is 50%. You have to get a mortgage for. You have to get 90 or 95% of the value of that 100,000. So, for example, you will probably get a mortgage for 95,000, and you will
Mhm.
put down 5%, which is £5,000, and then that means the 100, so you only get 100%, which is 50% share of the property. The other part you pay rent on. So how it works in practical terms is this. So what could happen is you might be paying, maybe, let's give just a rough example. You're paying maybe £1,000 a month. So out of that £1,000, you probably be paying a mortgage. Your mortgage will probably be maybe 400 or £400, and then you're paying rent on the remaining. And that is just be able for you to be able to afford it. So I know it's very detailed, so we can always talk about it in detail in a future session,
Yeah.
but I just want to touch on it briefly. I know people will have a lot of questions about that. They want me to explain it a bit further, but I just thought I should touch on that briefly. so
Mm.
so so like I said, I've mentioned one option is to take out a mortgage and then you put down a deposit. The other one is the part buy, part rent. The third model is what is going around, which people have been tapping into. It's called help to buy. So help to buy is tailored towards people who are buying their first property for the first time. And how it works is mainly because of affordability. I'm still going to come back to that affordability shortly. So
Mm.
where houses prices are quite high in places like London, people might not be able to afford to be able to buy. So what the government has now done really is, but mainly on new development. So this help to buy is only to do with new properties, brand new properties. So with developers, they have this kind of scheme with developers where they finance developers, And what would then happen is you find a new home you want to buy, which is part of the scheme. Let's say, let me give some practical figures. Let's say you find the property for £200,000. So in London, you can get up to 40. So you could get a loan. There's two parts of the loan. The government will give you what we call an equity loan. So they will give you 40% of that 200,000, which is 80,000 as a equity loan. You would then have to put down 5% of it as well, which is 5% of 200,000, which is, I believe, 10,000. And then the remaining, you have to take out a normal mortgage on. So what you have is that so it's three parts. So one part is the normal mortgage lender, which is 55%. So for a property of 200,000, you will take out a mortgage for 110,000. The government has an equity loan. Equity will come to why it's called an equity loan, which is 40%. So the government will then have 40% of 200,000 is 80,000. Okay, so the government will have an equity loan of 80%. The lender would give you a mortgage for 110, and then you put down the balance, which is £10,000, which is 5% of 200,000. The reason why you have that is you might not be able to afford, under the first example I gave you, you might not be able to afford to take out a mortgage for 180,000, or where the normal lender will give you 180,000 and you put down 10%, which is 20,000. You might not be able to afford that. So because you can't afford it due to your affordability, that's when you will do that. So that is why we have that. So there are three different schemes. Now, I'm happy to go into that in detail on each scheme at a later time. But I thought I would just touch on that, for everyone's benefit.
Yes.
So to go further, and so going back to what I mentioned at the beginning. So I've started to talking about mortgages. I've talked about the three different ways you have buying like a mortgage. With you just have one lender, and then you put down a deposit. I've given an example where you have part buy, part rent, and then the third option is what we call the help to buy. Now, and I mentioned things around affordability, and this is why I want to go into that. So
Yeah.
you start to understand why you might fall into any of those three categories.
Mm.
So affordability. So most times when you go for a mortgage, it's based on your income. It's based on your income, how much you can afford. So different lenders have different ways of looking at lending, but I'll just give you a rough idea. It's just rough idea. On average, you'll be looking at around 4.5 times your income. So let's say you find a property you want to buy. In order to get the mortgage, looking at how much deposit you have to put down, for the mortgage you require, you'll be looking around 4.5 times income on average. It might be more than that. Some of them might give you slightly a bit more than that. Or based on the kind of profession you are into. For example, people who are like doctors, solicitors, or some other professionals might get a bit more money based on their jobs. But generally, I would say roughly is around 4.5 times income. So that is what. So that means that, given the for example I gave earlier on, if you found a property you were buying for £200,000, and you then you were looking, so it means for £200,000, and you have to put down a deposit, like I said. So they say you have to put down 10%, which means 10% of 200,000 is 20,000. Means you have to get a mortgage for 180,000. So it means for you to be able to get a mortgage for 180,000, if you do the figures, it means you have to be earning at least £40,000. So in order to get a mortgage for 180,000, you have to be earning £40,000, because 40 times 4.5 gives you 180,000. And then you then have to put down 20% and 10%, which is 20K. So that is the outright say. So you can understand. So if you don't earn 40,000, it means you can't get an outright mortgage for 180,000. What are the options available for you? You either then look at your income, you multiply it by 4.5, you think, okay, this is what I can afford, and then you have to find a property which is lower in price. But as you know, depending on where you live in the UK or any part of the world, house prices are quite high. and you might not be able to afford it. So that's why you then have to look at those other options I mentioned, like shared ownership. Because rather than for the example I've just given you, rather for you to be getting a mortgage for 180,000, it could be that your mortgage you can only get a mortgage for 190,000. Sorry, for 90,000. So that means you could go for shared ownership, which means you own just 50% of the property, and then you then have to pay. The scheme is normally run by housing associations. So what will happen is you'll be paying rent to a housing association or a social housing landlord for 50% of that, and then you would then own 50%. And then what then happens is in the future you can actually increase your share, because you can go in by owning 50%, and as your circumstances improve, maybe you start earning more money, you can do what we call staircasing, which means you can increase your share. So you can go from owning 50% to 75% of the property. But I have to mention that in the future, it depends on what the price. As you know, house prices will keep going up. So, for example, let's say you had a shared ownership property where you're owing 50% of it, which is 90,000. Yeah. So it means the 90,000 is your own share of that property. Now, the property you were buying it, so don't let's from that example, the property was you actually own 90,000 of the 180,000. But what then happened in the future is that the property that was 180,000 or 200,000 then increase in value. It goes up to 250. So it means in the future, if you are trying to buy 50%, you're not going to be buying 50% of you're going to be buying 50% of whatever the future value is, because the price has gone up in value. So that's how the shared ownership scheme works. I know it's a lot, there's a lot around that, and I can go into that because I can talk on that subject. That on its own is a subject on its own. Each of the examples I've given you are subjects on their own. So, but I just thought I should mention that. So if you don't go for that option, then that might lead you to the third option, which is the help to buy. And the help to buy is mainly for first time buy. So it's around affordability. So affordability, they will look at how much income you earn, how much you spend on bills. You pay bills, you've got council tax, you pay your utilities, so they will look at all that. And also if you have any borrowings, like if you owe anything. So if you owe, I know most people have credit cards, they have loans, all that will be factored into how much they'll be able to borrow you. So that is what they're looking at for the ability. They're looking at your profile, how much money, how much you have at your disposal. So let's say you're earning a certain amount monthly. Out of that, how much money do you spend on bills? How much money do you spend on transport? How much do you spend on paying if you have loans and credit card? And that would affect how much money they'll be able to lend, which how much you'll be able to borrow from the lender. And that's around affordability. And that is important. The other bit is deposit. So depending on how high the price of the property is, that will determine how much deposit you have to put down. So like the example I was giving you, you find the property for 200K. It means if you're going to be doing for the normal mortgage, you'll be looking to put down at least 10%. So it means you have to put down 20,000. So for you have to look at, do I have 20,000? Have I have 20,000 pounds saved? So you put down 20,000 and you want to get a mortgage for 180,000. So it depends on how much deposit you have. That will kind of determine how much you'll be going for. The more money you can put down, the better your chances. So that I have to mention. Now, the third part I was mentioned is around your credit status. So I know people who live in London, other parts of the world know about credit status, credit ratings. Do you have good or bad credit ratings? Obviously, if you have bad credit ratings, that might impact on you being able to get a mortgage. Because if it means like maybe you've missed payments, so how do you have bad status? Where you have your mobile phone. You didn't pay your bill on time, that will factor in. There's something being recorded in your against you have a tick against your name that you don't manage, things like mobile phones. Maybe your utility bill, you did not pay your gas bill or your phone bill on time. That will get recorded against you. Maybe you have a car loan or something, you didn't pay the car loan on time. That will, so because what the lenders, they're looking at your history. That's what they call it, credit history. They're looking at your history. How have you managed money in the past? And that's how they call it, credit history. So that will determine whether the lender will give you a loan or not. Now, obviously, there's a whole process of that. Credit scoring, if you have a good credit score, a high credit score, it means you'll be managing your money very well. You pay your bills on time, you don't default, you always pay things on time, you don't miss payments. It means you have a good credit history. When you have a good credit history, it means, what that does as well is that it means you can get a good you could get a good mortgage product. And there are loads of lenders that will be happy to give you lend you money. But if you have poor credit history, then that might have an impact on which lender will be willing to lend you money. And sometimes you might not be able to get the mortgage. Sometimes you might be able to get it. But if you do get that mortgage, what you pay as interest might be higher based on based on that. So loosely, I've been able to go into the three different factors. The fourth factor I mentioned earlier at the very start was around your immigration status. Regarding that, you have to have at least a tier two status in order to get a mortgage. Different lenders have different criteria. So for that, and then from there on, I like to summarize, so because I've been talking for a bit, so people can at least know what I've been talking about. So I talked about the immigration status, and then I mentioned things about the three different factors. I mentioned having what deposit you have, savings you have to put down as deposit. I mentioned around your affordability, what you can afford, and I gave a loose example around payment, your what you earn, your salary, 4.5 times your income, and stuff like that.
Yes, yes. I
So,
just want to ask a few questions. Thank you very much.
okay. Yeah.
You've given us a bird eye view of the topic. Thank you
Yes.
very much for doing that. Um, Now I've heard people say to build a good credit score,
Mm.
you need to you definitely need to have either a bank loan, or you need to have credit cards. And some people are not comfortable with credit cards, some people are not comfortable with getting overdrafts and all of that. So how do people build a good credit score,
Okay. Thank you.
apart from you paying all your bills and all of
Yeah,
that?
yeah. Thanks for that question. Well, the credit score is just credit history. Now, credit history doesn't necessarily mean you have to go, especially for a first-time buyer, you have to go for overdrafts or loans just to build your credit score. Not necessarily, but there are other things you can take, like your mobile phone. It's a credit score. It's a it's you have a credit agreement. So if you have a mobile phone, there's a
Mm.
credit agreement for your mobile phone. How you pay your mobile phone, you know having a loan is only part of it. You don't necessarily have to take out a loan to have your credit history, because there are other ways you can show your credit history. Things like having a mobile phone. Most people have mobile phones. They have phone contracts. You have a contract, whether it's a mobile phone contract, whether it's a utility bill contract, what kind of contract. Yeah, that is it. Credit cards, you might not. The other thing is this: the idea about credit is not about really owing money. It's more
Mm.
like how you are able to pay back whatever you take out. So, for example, some people might do is they might take out a credit card, they spend and they pay it back at the end of each month. So
Mm.
it's showing that you can manage money well. You know, some people have a car loan. Most people have car loans. A lot of people have car loans. So that is a credit history. You can build your credit history from that.
Okay.
Like I said earlier on, having a phone bill, but not having any kind of history. So not borrowing any money at all. So you don't have a mobile phone. You don't have a utility contract. You don't have anything. The lenders are not able to kind of verify you in
Trust.
terms of how you're able to manage money. All they
Mm.
need to know is how you manage money. That's it. That
Mm.
is it. So you don't necessarily have to go out and start owing money, taking out overdrafts and stuff like that. You
Yeah.
don't necessarily have to do that. At the basic level, just tend to have contracts, like your phone contract, the normal contract that you have. Make sure you're paying things every month, when you should pay. And there's so many things you can take out, where you have to pay back. So as long as you're doing that, you're building up your credit history,
Yeah.
and that's what most lenders have to.
Yeah.
That's the starting point. Like I said, you don't necessarily have to start going and splash and start owing loads of money. So what people might do is that have a credit card, they spend in the shop, and at the end of before they pay it back, they
Mm.
spend, they pay it back, they spend, they pay it back. At least that way it shows that you'll be able to take
Yeah.
money and pay it back.
Yeah. Okay, great. Thank you. Thank you very much. So, one other question. I've got two questions actually.
Mm.
One is you said you need to have 4.5 times your income
Yeah.
to if you're going the route of having a mortgage with a deposit. Now, is it going to be just one partner? Is it going to be joint partnership?
Okay.
I mean, with your partner, with your husband or wife, or
Yeah.
can they do
Combined
they
income.
consider marriage
Yes.
if they're
Yeah.
living
It's
together, or
combined
just two
income.
friends coming together? Can they
Yeah.
do that?
Yeah.
Things like that.
Yeah. It is. You're right. It's combined income. Thanks for asking
Oh,
that
okay.
question. The 4.5 times income is just a guide,
Hmm.
but it's individual. That's just a guide, but it's based on one individual. Combined, so I'm just giving you a guide because it all changes from lender to lender, from company, from bank to bank. But sometimes you might have like joint income. Joint income might not have to be 4.5. It might be 4 times joint income. So if you have two people coming together,
Yeah.
multiplied by four, that is
Okay.
joint income. So, but different lenders have different things, and they have all their ways of working their affordabilities. But for
Hmm.
me, it's just a rough guide.
Yeah.
It's just a rough guide. Yeah, yeah. So combined income could be 4 times. Some lenders might even have less than that. Some will have a
Hmm.
little bit more than that. It depends. All the lenders all have their different ways, but that gives you just a guide in terms of what you're looking at. And not only that, it's not just about your income. They will look at, or they'll bring in other factors as well. Like if you've been in a job, so it helps sometimes. Like if you're self, so and then there's the other. There's so many things around this thing. There's
Hmm.
whether you're employed, whether you're self-employed, how long you've been in your job. Are you a temporary contract? Are you a contractor? Are
Hmm.
you a temporary worker? There's so many other factors that come into it, which I haven't even mentioned as well. But that is part of it as well.
Yeah.
So it's a
It's
minefield.
a
But
lot. Hmm.
yeah, but
True.
yeah, I'm happy. So where people come with questions, it's easier because in my mind, it's very hard to pick on every single part of the mortgage process. But it
Yeah.
helps when people ask questions because then I can then talk a bit
Yeah.
more on those things. Yeah.
Yeah. Thank you. So, viewers, you're hearing him. Write questions, just type it down there and he will deal with all of your questions. Here you are, free of charge, a golden opportunity for anyone who's got questions to ask. All right. So the final question I have is, where do you find the prices of houses?
Houses. Yeah.
A rough idea.
Okay.
I know there's some like Rightmove, Zoopla, but
Yeah.
as an advisor, do you have other channels
Okay.
of
Okay.
search?
Yeah. So right move is the most common one in terms of, if you're looking for properties, you've showed it on the screen. So if you want to have an idea, so wherever you live, you tap in. It's very easy with right move, isn't it? You just put in wherever you live or wherever you're looking to buy. You just put the address, you put the town there, you pick things like, you just put a house price or something based on what you think, put some price in, put the number of rooms you're looking at, put the kind of property you want, and then you can then have an idea. There's Zoopla as well. With Zoopla, there's something within Zoopla that tells you what prices are what in certain areas. So you have the main ones are Zoopla and Rightmove, where people advertise their properties on. So that is the main ones. And then locally, you've got your local agent. So where you live, you have agents who are on the high street. You can walk into any of the agents, you could look around because they always have property advertised on their boards. So you can always look at that, and then that gives you an idea what prices are and what you might be able to afford in the area in which you look. But like I said, Rightmove and Zoopla are the most common ones, and the online ones, it is good, they're quite good, and I will recommend those. You know for so really tonight, like I said, I have to mention this, a disclaimer. So I'm not giving advice, I'm giving mainly education because what we're doing today is mainly for education purposes. It's just
Yeah.
to educate people, it's not to give advice. i'm
Okay.
i'm not i'm not giving advice, I'm not licensed to give advice on this kind of
Okay.
forum.
Okay.
It's just
Yeah.
to give people, just to increase their knowledge. It's mainly
Mm.
just to educate people. And the
Okay.
idea is this: what we do with coaching is that we help people, we educate people, we give them all the, let them know have the knowledge in order to make the right decision. So
Yeah.
what will happen is, what I do with the coaching is, you give people a lot of information, that they ask you a lot of questions, you give them that, and then they sit down. And once they're ready to go forward, that's when you then sit in front of a mortgage broker or a
Hmm.
mortgage advisor, because the mortgage advisor will then give you advice in terms of, this is the job I used to do. That's the job I stopped doing to become a
Hmm.
financial coach. So the mortgage advisor will then look at the best product. They will then look at the lenders. They will look at various ways in terms of what is your best option in terms of getting a mortgage, and what suits you best. And they're regulated by the Financial Conduct Authority.
Yes, thank you very much. Exactly. We're all being educated here
Mm.
just to have information. Information is power. When we have the information in our hands, we're able to go the right direction, make the right choices. So yeah, thank you very much. If you've got any questions, please send them on the screen, tap them out, and it will be treated in the next topic. So this is part one of how to buy your home, buying a new home. What do you need to do? So send your questions, and Mr. Abdu will be ready to answer them. Thank you very much. Are there any last words you want to tell us before we go
Before we
tonight?
wrap up,
Is can people buy a land, or do they have to actually buy a
the
building
house,
in the UK?
you can
Do
actually
people
buy
buy
land.
lands?
That's a good
Mm,
question, but yes, you can actually buy land. Yes, you
wow.
can do what we call a self-build. So what will happen is, you will buy the land, and you can get there's finance to buy the land and to build, and it's called self-build. So what those are called self-build mortgages. So there's self-build mortgage where you take out the land, and there's a lot of value in that. I know it's not some people do, but it's very good. Why it's good is this: when you buy the land, and when you're buying a house from scratch, as you build, the value increases. So there's a
Okay.
premium in buying land, because when what will happen is, but from the moment you start building to the moment you complete the build, there's an uplift. And that's
Mm,
why. But it's just that, as you know, in the UK where we live, land is scarce.
mm,
Land is scarce. There's not a lot, and like, that's why most people will buy from developers, because with land, there's land somewhere else. They build estates. So if you work within your town where you live, if you're working within the city, you're not likely to find spare land next to you.
mm.
Like in places like Africa and other places, or part
Yeah.
of the world, you see
Mhm.
free land across the road and everywhere. But in cities or in the Western world, it's very hard to come across land in the town center, because yeah, there are parts of land. There's always
Mm.
land. People do buy and build on. It's not a common thing, but it is there. It's possible. So
Okay.
it's very possible where you buy the land and then you build in stages. And then what will happen with that is that the lender gives you the money in stages to build. So you build that
Mm.
house in stages, and the lender gives you money at each stage to build. So you start by
Okay.
buying the land, and then you build at different stages. But the good thing about it is that there's a lot of value in it, because from the moment you start building to the moment the house is completed, the value rises. You know.
Mm.
So that's one good thing about self-build. It's called self-build. Yes. So thanks for
Okay.
that question.
Great, great. Thank you. So, yeah, our buzzword, as you can see on the screen, you've got so many buzzwords and so many are being added to it. And so, for the next part of this discussion, we'll be talking about freehold, leasehold. So many people are confused about that as well.
Okay.
Like something like a land, how would it be freehold? Do you still have to
Yeah.
pay? Does it mean you don't
Yeah.
own it? And
Yeah.
and so many other questions like
Yeah.
remortgaging, renting to buy,
Yeah. Yeah.
buying to let,
Yeah.
inheritance tax,
Yeah.
mortgage free, being mortgage free.
Yeah.
Having to have finished
Paying off your
paying
mortgage.
off your debt.
Mm.
Some are saying, "Oh no, you don't have to." Some are saying, "Oh yeah, sure, you have to." There's so many things around it. So
Okay.
We are waiting for your questions so that we can move forward
Okay.
in this. So finish up the topic without you asking questions to know what exactly you want to know
No,
about mortgages. So thank you very much, Mr. Abudu. I really appreciate your time.
you're
You've spent
welcome.
so much time with us today, and this is golden time. Thank you very,
Yeah,
very much.
and I want to say thank you to you too, Bumi, because thank you for bringing me on the show. And I think what you're doing is great. I
Okay.
think it's something, I'm passionate about it. I would like to see people own their own home because it's very important. It's good to
Mm,
own your own home, because even if prices are not going up, the fact that when you retire, you're not paying rent to
mm,
anyone. You actually
mm,
own your home. It's not about house prices going up. It's not about, oh, you buy because you're going to make. No, the fact that, because at some point you retire, as you
yeah.
get old, you want to be
Mm,
in your own house. You don't want to be paying rent. So it
mm,
means what you pay out is less because you own your house. You don't have to pay rent to anybody. All you pay
mm,
is just your utilities, and you have less money to. You have more money to live on. So that alone is something. So anything
mm,
that will encourage people, young people, middle-aged people, even older, like older, anybody can get involved. But there are
yeah.
obviously different stages and different things to consider. But I'm
Yeah.
happy to shed light in so many of the issues you've just mentioned, and you thank me for bringing me on the show. And then when we go forward, we'll be addressing we'll go into the in-depth some of the things I've already spoken about, and some of those buzzwords we'll touch on them in our next session.
Okay. And of
Okay.
course, in the next session, we'll be asking how old can you be to start thinking of buying a home? Do you need to be, is it from when you're born? Is it from when you're an adult? Is it from when you're still in school? All of that. Don't worry, we will bring it up next time. So I won't ask now, but I've written it down so that I can ask next time. Thank you very much. I really appreciate your time.
All
Thank you.
right.
And we'll
Thank
see
you.
you next week. Thank you very much, everyone. So remember to like, share, subscribe, comment down below, and let us educate ourselves. Information is power. When we're informed, we make the right decisions. So enjoy your evening, enjoy your afternoon, enjoy your morning, enjoy your night, wherever you are around the world. And I'll see you next time. Thank you very much. Bye bye.